Hello, I'm Brendan, and today we're going to talk about the cap on credit card interest rates. As you may have heard, President Donald Trump is proposing to put a one-year cap of credit card interest rates of 10%. Let's take a look at his post. Please be informed that we will no longer let the American public be ripped off by credit card companies that are charging interest rates of 20 to 30% and even more, which festered unimpeded during the sleepy Joe Biden administration. Effective January 20, 2026, I, as President of the United States, am calling for a one-year cap on credit card interest rates of 10%. So that credit card cap would potentially impact $1.29 trillion in revolving debt. This is approximate from the Federal Reserve as of November 2025. That's a lot of debt for consumers that could potentially be reduced down to 10%. So let's look at some of the potential benefits for consumers. Lower interest costs. A 10% cap would sharply reduce the cost of credit card debt for many borrowers, especially those carrying balances. Research suggests U.S. households could save tens of billions of dollars annually in interest payments if implemented. Greater short-term affordability. Consumers paying high APRs, often 20% to 30%, would see monthly finance charges fall, which could improve disposable income and ease financial strain. Now, I've heard that a lot of people did go into debt after the COVID era so that they were able to survive because some people were laid off and they were living on credit cards. Also, we've seen inflation and people have been using credit cards to keep up with inflation. Now, some of the drawbacks of this, we could see a contraction in credit. Let's just look at this. Reduced access to credit. Lenders use interest rates to price the risk of default, particularly for borrowers with weaker credit histories. A hard cap would limit their ability to do so. Major industry groups warn that many accounts, especially those held by people with lower credit scores, could be closed or restricted entirely. Some analysis suggests that most cardholders with scores below about 740 might lose access to credit cards under a 10% cap. Tighter lending standards. Banks and credit card issuers could respond by tightening credit criteria, reducing limits, or cutting products to preserve profitability. This effect may be felt most by subprime and moderate income borrowers who rely on credit cards for everyday purchases or emergency needs. So if you could, put in the comments, do you have high credit card debt? Just put high credit card debt or high debt. I'm interested to see how many people would be impacted by this. Number 3, lower rewards and higher fees. Credit card reward programs like cashback, points, miles are largely funded by interest and fee income. With capped interest, rewards could be scaled back or eliminated. Issuers may introduce higher annual or penalty fees to compensate. Number 4, shift to alternative, riskier credit. When traditional bank credit becomes less available or attractive, many consumers may turn to buy now, pay later services, payday loans, or pawn alternatives, unregulated lenders. These often have higher effective costs or less consumer protection. Broader economic impact. Banking sector stress. Credit cards are one of the most profitable segments for banks. A cap could significantly reduce income, the interest income, pressuring margins. Financial stocks have reacted negatively to the proposal, signaling market concern about profitability and credit dynamics. Potential drag on consumer spending. If credit becomes harder to obtain, spending, a large component of the U.S. GDP, could slow as consumers shift to paying down debt rather than buying goods. Number 3, regulatory and legal challenges. A 10% cap isn't currently law. It would require congressional approval or new regulation, and there's considerable doubt about its passage. Economists and industry perspectives. Opinions differ. Supporters argue it could provide meaningful relief and reduce debt burdens for heavily indebted consumers. Critics contend that well-intentioned caps often result in reduced credit availability, fewer consumer protections, and unintended reliance on riskier lending. Now, I do remember in the 2008 Great Recession that this similar kind of thing happened when they restricted credit. It wasn't due to a credit card interest rate cap, but it was reduced credit availability, and that impacted a lot of people. I was one of those people. I had credit cards out there, and suddenly those credit lines were restricted, so I didn't have as much credit available. So I'm wondering if you would have that same impact. Put something in the comment below, and I'd like to hear your opinion about this. Also, if you like this video, please subscribe to the channel and like the video. And if you like what you're hearing, feel free to buy me a coffee. There's information in the description below how to do that. Thanks so much for watching the video, and we'll see you in the next one.